Hi there, eToro. It is Monday, the 20th of December, and that means that it's time to review what happened at the markets last week. Let's take a look. There's been some confusion around the stats that I've been reporting weekly, which confuses me because I've been reporting the same stats in the same style for nearly a year now. So I think some people think that I've been trying to pull the wool over their eyes in terms of my returns over the trailing 12-month period that I talk about each Monday. I wouldn't do this. It would be silly for me to do it. There are just too many ways for you to verify all the different aspects of my portfolio performance. So I'm not trying to pull the wool over your eyes. I literally just use the trailing 12-month figure that is inside of eToro, comparing myself against the S&P 500. But because of the anger that I have experienced through the past 2 weeks of posts, I'm not going to talk about these stats anymore. They are available all around eToro, so feel free to visit my portfolio and have a look at those stats yourself. I also wanted to just quickly remind people about my strategy. So I will do a longer video about this early in the next year. I'll review my 2021 performance, which hasn't been great. Obviously, that the number is there. There's no way to disguise it. And I wouldn't want to. So in terms of my strategy, I'm a long-term investor. Most of my positions, 80% of my positions in my portfolio, I intend to hold for many, many years. And then there are some that I trade a bit more opportunistically. So if you take a look, this information is available, well, most of this information is available on my profile page, but every few years I have a shitty year. So 2015, 2018, and this year have been crap. And although that stinks, I am still up. So this is correct as of the end of November, by the way. So it doesn't include December statistics. I'm up 559%. And this is because of my chosen strategy. So I tend to focus my portfolio in high growth software companies that are very strong, but might be out of favor now and again. And when they're out of favor, the stock price is shit and it underperforms the market. But over the long term, they tend to do pretty damn well. So Tesla is, as an example, I don't hold Tesla at the moment because I think it's expensive, but I held Tesla, I don't want to say before it was cool because that's lame, but I held Tesla many times over the past decade when it was out of favor, underperforming the market quite often, but over the long term, my positions there outperformed the market significantly. The same with AMD, the same with Nvidia, the same with Microsoft. So this is just my chosen strategy, and it's volatile even over year-long periods. Just a bit more on the period, the type of statistic that I was sharing historically, but I'm not going to be sharing it anymore. It was a trailing 12-month figure. And so whenever you look at figures in terms of whether it's a company, a particular asset, or a popular investor, you can pull figures for daily performance, monthly performance, month to date, year to date, trailing 12 months, 12 months, and they're all slightly different numbers. Being a long-term investor, I tend to look at my performance over longer periods, so 1 to 5, 10 years as an example. All right, so where is the market at the moment? It is firmly in the fear category, and it's been there for a while, as you might have noticed. What this means is that volatility has been pretty damn high, as you might also have noticed. So the VIX had quite a large jump over, I think it was about 2 weeks ago, but the volatility has remained elevated, and today it's jumped again. So you will have seen that many stocks are blood red today, and this is because of a combination of Europe is shutting down or increasing restrictions with regards to coronavirus, but also the Buildback Better bill in the US, the framework, is in a little bit of trouble, and it was an enormous bill that would have stoked quite a lot of growth in the US economy. So the markets are shaking out a little bit today. In terms of the 3 key US indices that I look at, you can see that the NASDAQ, the candles, have been jumping either nearly 1% or over 1% quite a lot in the past few sessions. Today's not a great day for the NASDAQ either. The S&P 500 has been slightly less volatile, but also isn't having a fantastic time. And people have run away and sold smaller cap stocks, as those that make up the IWM. Smaller cap stocks are considered to be more risky. And money runs away from small cap stocks whenever there's any kind of a sell-off in the market. Small cap stocks tend to be more volatile, by the way, but if you have the right ones, you can obviously outperform the market. So over the past week, the indexes have been red, just about all of them. Some of these, I know they're not indexes, they're ETFs, but they're kind of indexes of a theme or factor. So solar stocks obviously had a big sell-off. Chinese stocks had a big sell-off over the past week. Commodities also haven't had a great time, particularly oil, because of the increased lockdown measures. We're back in that frame of thinking where there's going to be less oil consumed, so the oil price is dropping again. And one stock that I wanted to call out from last week is Cineworld. Cineworld is the world's second largest cinema chain. It is a holding in our portfolio. It's pretty high risk for obvious reasons, but it is a fairly small holding within our portfolio. And it fell, I think it was 39% in one session last week when it lost a court case against a Canadian cinema chain that it was looking to buy. The reason that it fell so much is that the fine for the court case is larger than the market cap of Cineworld. I suspect that this is a bit of a negotiation tactic, and we're going to see some back and forth on this particular court case for a while. It's going to be costly, but I don't think it's going to be that costly. Just something to note before we've gone into the most recent lockdown, Cineworld was outperforming itself pre-pandemic in certain regions. So for example, in the UK, it was making more money, making more revenue than it was before the pandemic. So the company was recovering. Obviously, more lockdowns hurt the company. It is high risk, as I've said, so I'll keep my position small there. In terms of last week, so there are lots and bits and pieces of economic data that came out around the world from major economies, a lot of it very interesting, but the thing that really moved the market that everyone was waiting for were the meetings by the US Federal Reserve, the European Central Bank, and the Bank of England. So the central banks for those three geographies. The reason they were waiting for those meetings is because each of those organizations, those groups, were going to talk about their decision for interest rates over the coming year. And the Fed gave a little bit of a surprise, being a little bit more hawkish, negative, than was expected, and said that they expect 3 interest rate hikes through next year, and they're going to taper quantitative easing faster than anticipated, although the faster than anticipated was anticipated. So markets rallied a little bit on this, and that was a little confusing. But I think that there are a few things at play here. So just because the Fed has laid out this particular hawkish plan, it does not mean that it will necessarily abide by this plan. What this plan does give the Fed is some breathing room. So it might enact part of this plan and then change its mind later on. But by then it will give itself some space to maneuver, and that if rates have increased a little bit and quantitative easing has tapered somewhat, then they can turn on the taps once again and help support the economy without too much pushback. This wouldn't be the first time the Fed had laid out a plan, a hawkish plan, and then kind of changed its mind. So a similar thing happened through the last cycle, so 2008, obviously the great financial crisis, and then a series of quantitative easing programs. The last taper tantrum was around 2013. What is interesting to note is that the S&P 500 was volatile, but it continued to march upwards because this wasn't the end of quantitative easing, and it was just the beginning of the economic tightening within the US. The economy was still growing. And then part way through this tightening program, the US did bits and pieces of things that meant that they weren't tightening as much as they had originally planned to, meaning that the economy was supported and that growth, as represented by GDP, but also the S&P 500, continued its march upwards. In terms of the UK Central Bank, so the Bank of England and the ECB, European Central Bank, the UK said that it would raise its rate just a small amount, but it's effectively signaling that times are changing. It shouldn't have a huge impact on the economy right now. And the ECB did something quite surprising. So they've said that they will not increase rates through 2022. And in fact, they're going to expand one of their bond buying programs. That seems a little crazy, but we'll see if it works for the ECB. And so the theme overall is that the G20 and other countries around the world, either they are thinking about increasing interest rates or they're actively doing it. But the age of cheap money is now giving way to the age of cheap money. Now, I suspect that inflation is about to roll over. So commodities have kind of signaled this. The price of commodities has dropped significantly. Supply chains are beginning to ease. The cost of shipping things is beginning to ease. All of these things that have been contributing to a very heavy, sharp increase in inflation have started to recover. And so if inflation doesn't rise by as much as people are thinking and begins to ease off, then we might see a more dovish policy from various economies around the world. So if we step back and look at the reasons that people are afraid, they haven't changed much over the past few weeks. It's still, people are worried about inflation. They're worried about a slowdown in growth. They're worried about a spread of coronavirus. And I think we're still in the midst of a taper tantrum. The thing to note, though, is that we have been here before as a world and as a stock market. The coronavirus part of the equation is fairly new, but all the other bits and pieces they've happened time and time again. I don't think this is the market rolling over and the world moving into recession. The central banks are not going to allow that to happen. Also, in our fight against coronavirus, we are becoming better and better at it. The market and the headlines tend to focus on case numbers, but if you look at the efficacy of our drugs in keeping people out of hospital and alive, that's definitely increasing. We are getting better at this as time goes on. However, for now, through at least the rest of the year, I don't see the market moving hugely in one direction or the other. We're going to see a lot of volatility, but the market's not going to choose a direction because it is still worried about coronavirus, and we are still in the middle of a taper tantrum. So I find it quite useful in these instances to zoom out and think about a bigger timeline for particular companies. So ask yourself questions such as Amazon. Will Amazon be making more or less money 1 year from now? Will it be making more or less money 2 years from now, 5 years from now? Will the world economy be bigger 1 year, 2 years from now? And in most cases, I think that it will be bigger. And if that's the case, then the stock market will be just fine. There's going to be a bit of pain on the journey, but the market will climb that wall of worry. Okay, what about the current week? Well, I spoke briefly about the Build Back Better framework, and the media is saying that it's dead. However, I think it might just go back into renegotiation. We have to see. The timeline for it being approved might be pushed out. Maybe it is dead. There are pros and cons of this bill being passed as well as not being passed. We just have to wait and see. The reason that the market is reacting so strongly is because it was a huge amount of money, and that money was going to be spread all across the US economy, which obviously means that there would have been lots of revenue and profits for the companies that are beneficiaries of this bill. So if it doesn't happen, there are some stock prices that need to be unwound. Another very interesting piece of news this week is that China has cut its benchmark loan rate for the first time in a long time, but this isn't the first signal that they are easing up economically. I think this might be the third thing that they've done within the recent weeks that mean that there's going to be a bit more money sloshing around the economy. So it's a very small cut, but like I hinted at last week, there were rumors that this cut was coming, and there were rumors that there were more coming through the subsequent quarters. The reason is that China's GDP growth has been stalling a little bit for all the reasons that I've mentioned through this video. And so China wants to put a bottom under that and help the economy move back towards the growth phase. I think that Chinese equities have probably seen their bottom given the Chinese government's response in the past few weeks. And although the Chinese stocks aren't booming just yet, I think that over the next few quarters, we might see just that happen. In terms of economic data coming out this week, so GDP data will be closely watched, but of course it is Christmas and there will be lots of people that have already taken leave through this week and next week being New Year's. And so trading will be thin, there'll be very little volume, and that might help volatility. The lower volume is, the higher volatility tends to be. I might not create one of these videos next Monday. I need to decide, but I haven't taken a day off this year. So maybe I'll take next week off. And what is quite interesting is that we have earnings again. So earnings season will kick off for my portfolio today. Micron will be reporting. Nike isn't in my portfolio, but these two companies will kick off the season for us. All right, that's it for this week. I hope you have a fantastic Christmas, and I'll speak to you soon. Goodbye.